The vast majority of the trade press coverage of the removal of indexation relief for corporate capital gains focused understandably on the impact that that removal could have on the taxation of life policyholder funds. However, there are two other impacts, at least, that it could have, and I'd like to talk about those now. One is the impact on property holding companies, and two, the impact on corporate investment generally. So let's look at the first one. There has been, understandably, given all of the changes to largely negative, in fact wholly negative, on buy-to-let taxation, there's been a move for some buy-to-let investors to move their property portfolios inside a corporate structure. That has some benefit, particularly in relation to the relief for interest payments. However, it also has a tremendous benefit that inside a corporate structure, companies qualify for indexation relief on their capital gains. So that's not in relation to any particular company, it's not specific to property companies, just companies, until this recent change, have qualified for indexation relief. Now, how important is that? Well, when you consider that average house price increases, state average, over the last 10 years have been around 19 to 20%, and the indexation factor over that same period, over 10 years, would have been 32%, you can see quite simply, without being an arch mathematician, that there will be no tax on the capital gain made on your portfolio, on average. There will of course all be exceptions. So that's quite impressive and very useful to have indexation relief. If that's removed, that will mean the government will be gathering more tax, because you're still hopefully going to make some capital gain, but it will all be subject to tax, not just the real gains subject to tax. So that's one impact that will definitely have to be taken into account when considering how to hold your properties, whether to hold them inside or outside of a corporate structure. It won't be the only factor, but it is definitely something that now needs to be taken into account. So how about corporate investment generally? Well, when companies invest, they get, as I've already mentioned, until now at least, indexation relief on their capital gains. So if you're running a company, typically a private owner-managed company, and you've made some money, and it's sitting on deposit, not making very much money, if any, and you're considering, should we invest this to get a better return? Of course, you'll take into account, and I've referred to this in past videos, you'll take into account the impact that investment might have on entrepreneurs' relief, and overall, you'll be taking into account what those surplus funds do in relation to business relief or business property relief, depending on what term you want to use. However, if you do decide, having ticked both of those boxes, to make an investment in an attempt to get a better return, then making that investment into a collective investment, a unit trust or an OIC, something like that, would hopefully give you a better return, but from a tax standpoint would also be quite impressive, because the dividends generated, whether you take them or not, will be tax-free. No change there. The capital gains that you are accruing will not be taxed until you actually trigger the capital gain, so you make the disposal. And until now, the capital gains would have also qualified for indexation relief at the RPI rate, which projected forward is over the next 7 years going to be around 3%. So quite a useful package of reliefs. The first two you'll still get, CGT deferment and no tax on the dividends, you just won't get indexation relief. Does that mean you should change your mind in relation to the investment? Well, in relation to the underlying investment considerations, no, because you're still going to want to get a return on your money if you don't want to just leave it on deposit. But should you wrap that investment in an investment bond? Probably the answer from a tax standpoint is probably still no, because of the rules that have been with us for some time now, where you effectively, unless you're a micro entity, you'll be looking through to the underlying funds and paying tax on the growth in value year on year, whether you make it or not, would mean that the bond doesn't really look a tremendous tax deferment vehicle. And you get the CGT deferment on a collective anyway, plus you get completely tax-free dividends. So it probably doesn't change it, the decision making. It means that investing in collectives for companies is slightly less attractive, but still, taken as a whole, still look quite a reasonable consideration to take into account if you've got spare money and you want to invest it to make a return. Now, we covered this relatively complex subject with all of the peripheral considerations you have to have or take into account. As I've mentioned, entrepreneurs relief and business relief, we cover them in great detail in TechLink. I would encourage you to have a look under corporate investment.